Welcome to Group Insurance Daily Pulse, your rapid-fire deep dive into the most critical shifts impacting our sector. I'm Aria, the Actuary, dissecting the P&L implications and regulatory tripwires.
And I'm Dorian, the Distribution Expert, here to illuminate the market opportunities, ROI potential, and enhanced employee experiences. We've got a packed agenda today, covering everything from AI modernization to legislative mandates. Let's not waste a second.
First up, a massive play in digital transformation. HCLTech and Guardian Life have just inked a 7-year AI-powered modernization agreement. This isn't just a vendor contract, Aria. HCLTech is acquiring Guardian India operations for a cash consideration of $10.5 million, integrating nearly 2,000 Guardian India employees by August 1, 2026. This move promises significant AI integration across Guardian's data, applications, and engineering, spanning group benefits, individual protection, retirement, and wealth management. We're talking about next-level efficiency, reduced OpEx, and accelerated time to market for innovative solutions. This is a clear signal. AI is no longer optional. It's foundational for competitive advantage and a superior customer journey. Next-level efficiency and superior customer journey are appealing headlines, Dorian. My actuarial lens, however, focuses on the immediate and long-term solvency implications. A $10.5 million cash consideration, while seemingly modest in the grand scheme, directly impacts Guardian's liquidity and capital ratios, at least initially. The integration of 2,000 employees into HCLTech represents a monumental HR and operational risk. Data migration security across international borders, especially involving PII and PHI, demands rigorous adherence to diverse regulatory frameworks, GDPR, HIPAA, CCPA equivalents, not just the Department of Insurance guidelines. We're talking about potential data integrity issues, model governance challenges for the AI components, and the ever-present risk of vendor lock-in. What's the projected ROI timeline on this 10.5? $5 million CapEx. And how are they mitigating the inherent bias risks within new AI models that could inadvertently impact underwriting or claims processing, leading to unanticipated claims leakage or regulatory scrutiny? My concern is the potential for unforeseen operational friction and compliance costs to erode those projected OpEx savings.
Aria, the strategic intent here is precisely to reduce long-term OpEx and enhance competitive positioning. The integration of 2,000 skilled professionals already familiar with Guardian's ecosystem mitigates significant onboarding risk. HCLTech's acquisition signals deep commitment, moving beyond a transactional vendor relationship to a true strategic partnership. This isn't just about cost reduction, it's about unlocking new revenue streams through faster product development and hyper-personalized service.
Market share expansion is contingent on flawless execution, Dorian. Any misstep in data security or AI model validation could trigger severe reputational damage, regulatory fines that dwarf the $10.5 million, and a catastrophic erosion of policyholder trust. Shifting gears to a direct win for employee financial wellness, Sun Life US has partnered with Claritev, a healthcare technology firm, to significantly improve supplemental health benefit utilization for self-funded employers. Claritev's machine learning technology will identify diagnosis connections between employees' medical claims and their critical illness, accident, and hospital indemnity coverages. This means Sun Life can proactively engage employees when they're eligible, ensuring they access the financial support they're entitled to. This is a game changer for employee experience, driving higher benefit utilization, improving financial literacy, and ultimately boosting employee retention for our employer clients. It moves us from passive benefit provision to proactive advocacy. Proactive advocacy, or proactive claims leakage. While the intent to enhance benefit utilization is commendable, my primary concern immediately gravitates to data privacy and the potential for adverse selection. Claritev's machine learning technology will be parsing sensitive medical claims data to identify eligibility for supplemental benefits. This raises critical HIPAA and state-specific PHI compliance questions.
Aria, the architecture is designed with compliance at its core.
Claritev's technology is built on secure, HIPAA-compliant platforms, and data use is strictly governed by agreements focused solely on benefit eligibility identification. This isn't about increasing claims, it's about correct claims utilization, ensuring employees receive benefits they've already paid for, but might not realize they're eligible for due to the complexity of plan documents. This reduces friction in the claims process, which is a major driver of employee dissatisfaction. From an employer ROI perspective, better benefit utilization translates directly to a higher perceived value of the benefits package, enhancing employee satisfaction and retention. This isn't adverse selection, it's informed selection, mitigating the cost of underutilized benefits. The ML models are continuously refined, and the engagement strategy is carefully designed to be supportive, not intrusive. Informed selection that could still materially impact the frequency and severity of claims beyond initial pricing assumptions. The actuarial models for supplemental health products rely on certain utilization patterns. If Claritev's intervention significantly alters these patterns, the existing premium rates for self-funded groups might become inadequate, necessitating adjustments that could be poorly received. We also need to consider the integration challenges with existing claims administration systems and the potential for latency or errors in data transfer. What's the auditability of the ML decisions? How do we ensure that the ML doesn't inadvertently create disparate impact on certain demographic groups or medical conditions? The operational overhead of managing this new engagement layer, even if automated, adds complexity. This partnership needs a robust P&L impact assessment, accounting for potential shifts in claims experience, administrative costs, and the risk of regulatory scrutiny over data handling practices. Moving to regulatory impacts, Pennsylvania House Bill 2700, introduced July 14, 2026, is a seismic shift for employers. It proposes mandating comprehensive benefit disclosures in every job advertisement for employers with 15 or more workers.
Competitive differentiator or an administrative nightmare, Dorian? This bill, if enacted, presents an immediate and substantial compliance burden for employers. The specificity required, actual premiums, cost splits, deductibles, means HR departments will need to overhaul every job posting and offer letter template, potentially several times a year as plan designs or premiums change.
This isn't a one-time setup, it's an ongoing, high-frequency data maintenance task. For group insurance carriers and brokers, this mandates a radical shift in how we provide benefits information to our employer clients. It must be granular, easily digestible, and instantly accessible for integration into job ads. My primary concern is the potential for misrepresentation claims. Any discrepancy between the advertised benefit and the actual plan details, even a minor one, could lead to litigation. Furthermore, it creates a transparency paradox. While empowering job seekers, it could also expose smaller employers with less robust benefit packages to a competitive disadvantage, potentially hindering their ability to attract talent. The administrative cost burden on employers, particularly SMBs, could be significant, translating into increased fees for benefits administration or reduced flexibility in plan design.
Aria, this legislative trend towards greater transparency is inevitable. Forward-thinking employers will leverage this as an opportunity. Instead of viewing it as a burden, they can use comprehensive benefit disclosures to showcase their commitment to employee well-being, attracting top-tier talent. For brokers and carriers, this is an impetus to develop more user-friendly, API-driven solutions for benefit communication. We can provide templated disclosures, real-time data feeds, and educational resources that turn compliance into a strategic advantage. Imagine a QR code on a job ad linking directly to an interactive benefit summary. This pushes the entire industry towards greater clarity and standardization, which ultimately benefits everyone. The fines, while substantial, are designed to incentivize compliance, not punish employers. This is about elevating the perceived value of the total compensation package, which directly impacts talent acquisition and retention.
The value of the total compensation package must first be accurately and consistently communicated, without exposing the employer to undue legal or financial risk. The operational costs associated with this granular disclosure, including legal review, data management, and the potential for increased HR staffing, will inevitably impact the employer's P&L. This could lead some employers to simplify their benefit offerings to reduce disclosure complexity, potentially limiting employee choice. We also need to consider the enforcement mechanism. How will the Department of Labor or a similar agency audit thousands of job postings daily? This could lead to a patchwork of enforcement, creating an uneven playing field. From an actuarial standpoint, any pressure on employers to disclose specific premium splits might also lead to pressure on carriers to reduce those employer contributions, impacting our top line. This is a significant regulatory hurdle that demands proactive engagement from the group insurance industry to ensure practical and compliant solutions. News item 4. The Hartford appoints former AssuredPartners CEO to board, reports strong Q1 2026 financials, and Unum Group reports strong Q1 2026 earnings, increases quarterly dividend by 9.8%. Let's pivot to carrier performance and strategic leadership. The Hartford just appointed Randy Larson, former CEO of AssuredPartners, to its board. This is a brilliant strategic move, bolstering their distribution expertise at the highest level. Larson joining the Finance, Investment, and Risk Management Committee and the Nominating and Corporate Governance Committee signals a deep focus on market penetration and channel optimization. Brilliant strategic move or potential for channel conflict. While Randy Larson's distribution expertise is undeniable, integrating a former CEO from a major brokerage onto the board requires careful navigation of existing relationships with other distribution partners. His influence on the Finance, Investment, and Risk Management Committee will be critical. How will his insights, inherently tied to brokerage incentives, balance against broader P&L objectives and long-term underwriting profitability? The 36% increase in net income is strong, but we must contextualize it. Investment income, underwriting results, or expense management. And the 3% premium growth in employee benefits, while positive, needs to be analyzed for its sustainability against market saturation and competitive pricing pressures. What's the persistency rate behind that growth? Is it new business or a stable block? My concern is ensuring that a drive for market share doesn't inadvertently compromise underwriting discipline or increase exposure to adverse selection, ultimately impacting the future solvency.
Aria, Larson's appointment is about optimizing distribution, not creating conflict. It's about understanding the broker ecosystem intimately to better serve employer clients and expand market reach through diverse channels, including direct and digital. This is about strategic growth, not just growth for growth's sake. And speaking of robust performance, Unum Group's Q1 2026 earnings are stellar. EPS of $2.14, beating consensus by 7 cents. Revenue hit $3.36 billion, surpassing expectations by over $400 million, an 8.5% increase year over year. This financial strength is further underscored by a 9.8% increase in their quarterly dividend to $0.505 per share. This isn't just a win for shareholders. It signals immense confidence in the future of workplace benefits. It provides Unum with significant capital flexibility to invest in product innovation, technology, and further market penetration, directly impacting the services offered to employers and positioning them strongly against competitors. This is a clear indicator of the sustained profitability and growth potential within our group insurance sector.
Unum's Q1 performance is indeed strong, Dorian, but we must look beyond the headline numbers. While EPS and revenue growth are positive, the sustainability of this trajectory requires deeper analysis. What were the underlying components of that 8.5% revenue increase? Was it premium growth, investment income, or a favorable claims experience? The increase in the quarterly dividend by 9.8% signals shareholder confidence, yes, but it also directly reduces retained earnings and impacts capital reserves. While their balance sheet appears robust, any significant increase in claim severity or frequency or a downturn in investment markets could quickly pressure those reserves, potentially requiring actuarial reserve strengthening. We need to assess their interest rate sensitivity, especially for long-duration disability products. How much of this profitability is attributable to favorable mortality or morbidity experience that may not persist? And what are the long-term implications of this increased dividend payout on their ability to fund future liabilities, especially against the backdrop of an evolving regulatory landscape and potential new capital requirements? While significant capital flexibility is the goal, reducing the capital base via dividends must be balanced against the inherent risks in long-tail insurance products and the need for a strong solvency margin.
Aria,
These results from both the Hartford and Unum demonstrate the resilience and strategic agility of major players in the group benefit space. They are reinvesting in their businesses, optimizing distribution, and delivering value to shareholders, while simultaneously enhancing the employee experience through robust benefits offerings.
Effective management, Dorian, is precisely what we continually scrutinize. Strong financials are a snapshot. Sustained solvency requires constant vigilance over underwriting discipline, reserving adequacy, and capital deployment, especially when market dynamics and regulatory pressures are in flux. That wraps up another intense edition of Group Insurance Daily Pulse. We've covered the intricate dance between AI innovation and regulatory compliance, and the critical balance between market growth and actuarial prudence.
Indeed, Aria, the industry is moving at warp speed. From AI partnerships transforming operations to legislative mandates reshaping benefits communication, staying informed is key to navigating this dynamic landscape and seizing new opportunities.
For Group Insurance Daily Pulse, I'm Aria, the Actuary.
And I'm Dorian, the Distribution Expert. We'll be back tomorrow with more rapid-fire insights.